What if you could learn to invest like the greatest investor of all time, without getting lost in financial jargon? In this video, we're breaking down The Warren Buffett Way by Robert G. Hagstrom, a masterclass on how Warren Buffett thinks, invests, and builds wealth. Whether you're just starting out or sharpening your strategy, these principles could change how you see the stock market forever. This isn't about some get-rich-quick scheme. This is about building real, lasting wealth. The kind of wealth that lets you sleep at night. So, grab your notepad because we're about to dive into the mind of the Oracle of Omaha. Let's get one thing straight. Buffett isn't a trader. He's not chasing the next meme stock or jumping in and out of trends trying to time the market. That's a fool's game, and he's got billions of reasons why. His strategy is grounded in value investing. What does that mean for you and me? It means buying high-quality companies, businesses that are built to last, for less than they're actually worth. And then here's the key, holding them for the long haul. Think of it like buying a house, not flipping a condo. You're looking for solid foundations, a good neighborhood, and you're planning to be there a while. You're not trying to make a quick buck on a paint job and a new mailbox. This isn't about gambling on short-term swings. It's about understanding the businesses you're investing in, believing in their long-term potential, and letting the power of compounding work its magic. That's how you build real wealth. And that's what we're going to uncover today. Alright, let's break down the secret sauce, the 12 core tenets that guide Buffett's investment decisions. These are the filters he uses for every single stock, so pay close attention. First up, business tenets. Is the business simple and understandable? Buffett doesn't invest in what he doesn't understand. That's why he avoided the dot-com bubble like it was the plague. He sticks to his circle of competence. Does the company have a consistent operating history? He's looking for steady, reliable performers, not flash-in-the-pan businesses. Are the long-term prospects favorable? He's asking, will this company still be around and thriving in 10, 20 years? Next, management tenets. Is management rational in capital allocation? Are they reinvesting profits wisely to grow the business? Are they transparent with shareholders? Do they communicate openly and honestly? Do they act with integrity? Buffett looks for CEOs who treat shareholders like partners, not piggy banks. Then, financial tenets. Does the company generate high returns on equity? He wants to see that they're using their money effectively to make more money. What are its owner earnings, cash flow? Not just profit on paper, but actual cash coming in. Does it maintain strong, consistent profit margins? He's looking for businesses that can weather storms and keep a healthy bottom line. Finally, market tenets. What is the intrinsic value? What is the company truly worth based on its assets and earnings power? Is there a margin of safety? Buffett always buys with a discount, leaving room for error. How does the price compare to its value? He's a bargain hunter at heart, looking for those hidden gems the market has undervalued. Remember, the market is a voting machine in the short term, but a weighing machine in the long term. Now let's talk about some of Buffett's most famous rules of the game. These are like golden nuggets of wisdom, so listen up. Rule number 1, never lose money. Sounds simple, right? But you'd be surprised how many people forget this one. Rule number 2, never forget rule number 1, it's that important. Invest in companies with durable competitive advantages, what he calls economic moats. These are the businesses with a clear edge that can fend off competition and protect their profits. Think brand recognition, cost advantages, or unique technology. Avoid debt-heavy businesses. Debt can be a killer, especially during economic downturns. Buffett prefers companies that can fund their growth and weather storms without relying on borrowed money. Be fearful when others are greedy, and greedy when others are fearful. This is classic Buffett. When the market panics, he goes shopping. When everyone's euphoric, he's cautious. Remember, you don't have to be right all the time to be successful in the market. You just have to be right when it counts. Chapter 4, Buffett in Action Case Studies, Learning from the Master. Let's bring this to life with a few examples of Buffett's strategy in action. Coca-Cola in 1988. Buffett bought a massive stake in Coca-Cola back in 1988. Why? Because it had a strong brand, consistent global demand for its product, and ridiculously high returns on capital. People were always going to drink Coke, and that wasn't about to change. American Express. He bought it after a scandal rocked the company. The market overreacted, but Buffett saw long-term value. People still needed credit cards, and American Express had a strong brand and a loyal customer base. He was right, and the stock soared. C's Candies, a simple business with brand loyalty and pricing power. People love their C's Candies, and the company could raise prices without killing demand. Simple business, predictable profits. Notice a trend here? These weren't high-tech companies, they were simple, solid, and undervalued. Buffett understood them, believed in their long-term potential, and the rest is history. Chapter 5. Emotional Discipline. The Buffett Mindset. More than any stock-picking formula, Buffett's real edge isn't just strategy, it's psychology. He's mastered the mental game, and that's what sets him apart. He stays rational when everyone else is emotional. The market is driven by fear and greed, and Buffett knows how to stay above the fray. He doesn't get caught up in the hype or panic. He makes calculated decisions based on logic, not emotions. He ignores the noise. He famously doesn't watch the ticker tape all day. He doesn't get bombarded by every news headline or market fluctuation. He focuses on the long game, not the daily ups and downs. He doesn't check stock prices daily. He's not obsessed with short-term movements. He knows that real wealth is built over years and decades, not days or weeks. He lets his investments work for him, patiently and consistently. He lets compound interest do the heavy lifting. This is the most important part. Time is your greatest ally in investing, and Buffett understands this better than anyone. He lets his investments compound over time, turning small gains into massive wealth. Remember, patience isn't just a virtue, it's a superpower. Chapter 6. Your path to financial freedom starts now. The Warren Buffett way isn't about getting rich quick. It's about getting rich right. It's about building a solid financial foundation that will last a lifetime. Understand the businesses you're investing in. Don't just buy tickers, buy companies, do your research, understand their financials, and believe in their long-term prospects. Buy them at a discount. The market is not always efficient. There are always opportunities to find undervalued companies. Be patient, do your homework, and wait for the right pitch. Hold them for years. Let the power of compounding work its magic. Don't get scared out of your positions by short-term market fluctuations. Remember, you're in it for the long haul. If you got value from this breakdown, drop a like, subscribe, and comment below. What's one company you believe in long-term? Look, I get it. You see these crazy stories about people getting rich overnight, and it's tempting to think there's some secret shortcut. But the truth is, building real wealth takes time, it takes patience, and it takes discipline. The good news is, you don't have to be a genius to invest like Warren Buffett. His principles are simple, they're timeless, and they work. It's not about chasing the next hot stock or trying to time the market perfectly. It's about finding those solid, undervalued companies that are going to be around for the next 10, 20, 30 years, and letting your money work for you. So, start now. Do your research, stay disciplined, and remember, the only person stopping you from achieving your financial goals is you.